Good morning. Today is Friday, November 11th. Happy Veterans Day. And thank you to all of our great veterans for great gift to this country. Today, we're talking about the bond market's closed today. So Tom will be here, but
trading stocks,
trading
no bonds
stocks.
today.
So watch out. But the strong market rally yesterday, we'll want to start off there and talk a little bit about that, why it happened and what we can expect going forward. Obviously, yesterday, the CPI, the inflation number coming in significantly lower, was a very good positive. And in connection with that, interest rates fell dramatically. And this was the third biggest one-day easing of financial conditions since at least 1982. They eased about, by Goldman Sachs' estimate, 0.49, which is a 7 sigma move. So for those of you who don't deal in standard deviations, or certainly 7 standard deviations, this would happen once out of every 3.1 billion years if this was a normally distributed parametric model. Of course, that's not the case. We all know that there's jump conditions and things don't happen normally in financial markets, but that's the degree of the move that happened. It's only the third biggest easing since at least 1982. The other ones occurred on March 24th, 2020, which was 0.57. And on that day, the market rose 9.38%. The second biggest was 0.54 easing. And on that day, the market rose 9.58%. And then yesterday, of course, we just managed to muster out a measly 5.5%. So if you actually look at the easing of financial conditions, the move yesterday was fairly benign. I would say we don't want to have the biggest one-day tightening of all time, because that happened on October 19th, 1987, and the market fell 20.5% in a day. So we want to make sure we avoid that going forward. That was a 15 standard deviation move. But Tom, rates are really told the story for the day. Lower rates, higher stock prices, easier financial conditions, more stable capital markets. That was the story. What happened in interest rates?
I mean, really what we saw was one of the biggest single day moves I've ever seen in interest rates. I mean, outside of the Fed stepping in to pull out all the stops in March of 2020, when, they basically stepped in and dropped rates to zero. I mean, it was about an equal move, which is crazy to think now that like the Fed didn't do anything yesterday and the markets corrected themselves to such a harsh degree. And we talked about it at the call yesterday. We basically went from a 415 to a 395 on the call on the 10-year. Well, right now we're sitting at a 381. So we moved basically about that much again over the course of the day. We had the 30-year fall from about 425, 430 all the way to 4. And then they did an auction, which you would anticipate in a day where the price of something has risen more than it has on 99.9% of all days it's ever existed, that the demand at that level wouldn't be that strong. But we had one of the strongest 30-year Treasury auctions in the history of Treasury auctions. I mean, it was just unbelievable. It had a 3 basis point stop through, which is kind of inside baseball, but that's basically saying, hey, they tried to sell it at one price and everybody wanted to buy it for more. And that's basically how it went on the 30-year auction. So I think we're just basically seeing a massive overcorrection, in my opinion. I think that we're still not out of the woods. I think we won one major battle, which is that we got inflation down more than we thought for the first time in a while. I think that there are a lot of things that are in play that could potentially move us back the other direction, like the fact that we're going to not be focusing on midterm elections, and therefore we're not going to be focusing on oil prices. We're not going to be having all these different measures in place to make everything seem better than it actually is. And once that starts to filter through, I think we're probably going to have a tough time having an additional print where we're coming down again.
Not to mention easing financial conditions, mortgage rates down 55 basis points to 6.5%. They were over 7% the day before. That's people are going to say, hey, look, rates are down. I'm going to buy a house.
Yeah. I mean, we saw that over the summer where we got a little bit of a head fake. Everyone thought, oh man, this is over. The Fed's going to pivot. The markets rallied really, really strongly. Everyone felt good. Thought they had a little bit more, walking around money as a result, and rates dropped pretty significantly. We saw a lot of companies issue debt. We saw a lot of people buy houses, and suddenly we reaccelerated in inflation again, heading into the last couple of months. And so I think it's not outside the realm of possibilities that this is a massive head fake. We've seen expectations on rate hikes drop significantly. We're basically locked in no matter what. There's no chance of a triple rate hike in December at this point. And, it looks like they may raise once, maybe twice in the next year, but that's coming down rapidly as well. Like even in real time, it's kind of hard to tell what the expectation for the terminal rate is and when that's going to happen. And I do worry that we're getting a little ahead of ourselves in terms of the intense jubilation we saw in the markets yesterday, both in the bond market and the stock market. That being said, it's possible that inflation really could be coming down. China, announced that they're basically gotten rid of the COVID zero. Looks like they're going to be easing up really quickly, and the market seems to be rallying this morning on that. So the rally has not stopped, and it's one of those things where the bond market is closed, but that doesn't mean you can't buy bond ETFs that trade on the stock market, which means that there's going to be a true up. So if people think, man, I had massive FOMO yesterday, those are some of the highest rates, they're still very high, I want to get in on that before they go away. Well, that's all going to accumulate over the weekend. And so we could see another really big move up on Monday when those ETFs have to true up and actually buy securities in the open market to reflect all the buying that could happen today. Assuming that happens, I assume there's probably going to be a fair amount of that today.
And that could perpetuate the bull mentality.
And people, that perpetuates the dropping in rates, and it's possible we can get all the way to 6 by next week on mortgage rates. People are going to think I'm going to strike while the iron is hard. That could reaccelerate the housing market, reaccelerate almost everything, because there's so much buying that goes into the involvement in home purchases.
For perspective, if you had a $400,000 mortgage on Friday and you came, Friday, what's the day? Friday. Today's Friday. If you had a $400,000 mortgage on Wednesday, you could have had the same mortgage payment yesterday and had a $425,000 mortgage. So you increased your purchasing power significantly just because of that 55 basis point drop in one day. And that's going to bolster prices.
Yeah. It's
mathematically,
it's really incredible what happened yesterday. And so, not to sound like a bummer, because everybody's accounts are going to look awesome today. And they looked awesome yesterday. And we had some really good performance in a lot of accounts where we were up even more than the market. But that being said, I would say keep expectations tempered. Be wary that this could reaccelerate inflation just based on the fact that everybody suddenly feels awesome, unless you own Bitcoin.
Yeah, but even Bitcoin did well yesterday. Right now, I think what we have right now is a financial market recession. Anything tied to financial markets, financial market conditions is having a tough time, whether you're talking about housing, whether you're talking about stock market, investment banking, M&A, crypto, all of that's having a tough time. Economics will ultimately play a role here. Right now, financial market conditions financial markets eased yesterday, stocks went up. That at some point you have some normalization in that. Moving onto policy, we're going to talk a little bit about oil, but first I want to talk about the student loan forgiveness plan. Just big takeaways. It was struck down by a Texas judge. So right now it won't be able to go through unless it gets appealed and overturned. The plaintiffs were given standing, which was the big issue, because the question here was not even the legality of what the administration did, but who is harmed by what the administration did. And so the Texas judge gave these plaintiffs standing because they weren't eligible for the debt relief. And then he was actually able to litigate the case and said they overstepped, et cetera, et cetera. Everything that we've been talking about. What's different here is that they were actually given standing. So they actually had a voice in the courtroom. Previously, that wasn't the case. Why were they given standing? Well, one had private student loans, so they weren't eligible for it. And the other wasn't a recipient of a Pell Grant, so didn't qualify for the additional $10,000 in forgiveness. I think that these plaintiffs are probably getting paid by plenty of lobbyists elsewhere. So I think they're definitely getting plenty of money here. You can argue back and forth about whether or not they should have been. The consequences of this, though, are in January. If this plan doesn't go through, what happens when students have to pay back their full student loans? with existing rules on the books, it could get extremely complicated. Behind the scenes, the Biden administration has been working on contingency plans for this, but we know nothing about that. Tom, any thoughts on the implications here? I think it could result in a significant slowdown in the economy beginning in January.
I mean, I think it's a real shame that people have to pay back money that they borrowed. What a travesty, in my opinion. You take out student loans and man, what are the odds you got to pay them back? What an absolute disaster. That's my opinion. If you're going to do it, if you're going to borrow money from somebody, you got to pay them back. That's my opinion as someone who markets in debt securities. The worst possible scenario is someone doesn't pay it back. And so, I know that it affects a lot of people. A lot of people have student loans. Listen, man, it took me, I was 30 years old to pay off my student loans, but no one gave me any relief during the great financial crisis, and I got no sympathy. So that's how I stand on it. I know it's a harsh take, but I'm an old man with a mustache. You know what I mean? So dad vibes.
I have $20,000 more in student loans now.
So sorry about it. My bad. Go get a job.
Shifting gears to oil markets, OPEC Plus is cautious about future production, which I think is basically key to they might cut production again in December. Right now, the President Biden is in Egypt, actually, but he's at a COP27 climate summit. He is looking to bolster methane emission restrictions for oil and gas production, which I think will only serve to hurt oil and gas production. The EPA rule won't go into effect until middle of next year, but I think this only serves to increase the tightness in energy markets and increase the distrust with which energy producers view the current administration. In company news, Amazon is looking to cut costs, potentially even on the Alexa business, but they're continuing to invest in areas of growth potential. That was a big story yesterday. The stock was up, I think, close to 13% at some points. And then Elon Musk, Tom, and I'm interested to hear your thoughts on this. In a message to Twitter employees at an all-hands meeting on Thursday, he said that bankruptcy is a potential outcome here, which if I'm a banker, if I'm Morgan Stanley, Bank of America, Barclays, these guys who just lent money to Elon Musk a few weeks ago to buy this company, and then he's talking about defaulting on that or restructuring that debt, I'm like, I'm never doing business with you again. But is that how bankers think, or are they just trying to get the origination fees?
I mean, I think that the bankruptcy is always a possibility, is a potential outcome, right? So bankruptcy is a potential outcome here. That is true. I think the issue really is that, you've got a lot of people who are putting pressure on advertisers to pull away from Elon Musk because the most crybaby 9% of the population that tries to get everybody canceled and bring everybody down and can never be appeased is putting a lot of pressure on companies right now not to do business with Twitter. But I think at the end of the day, they're going to get some more advertising revenue. I think he's going to think of creative ways to generate revenue. I think the $8 a month thing for the check mark probably has legs. I think that a lot of people are either addicted to Twitter or on there quite a bit. I mean, I know that, I look at Twitter all day, every day, either for news on, college football or the markets, or, there's a bunch of people who I plug into 100% for market information as it comes out. So I think of it as an essential, news feed for myself. I think he's playing, he's posturing. He's known for posturing. He did it with the funding secured thing with Tesla, that he was going to take it private. And that wasn't really true either, but I think that if you put that fire underneath people and say, hey, we're all going to be out of a job if we don't figure this out, I think is really more the message he's trying to put. And it also kind of makes it also puts them in a power position over the banks, which is they're like, we don't want to get defaulted on. Again, if you lend somebody money, the worst thing that could happen is you don't get paid back. So I think that puts him in a bit of a power position, and he can basically use other people to push that narrative for him by having them either leak it or publish. Oh man, what are the worst things that could happen with Elon Musk, when it gives him a little bit of leeway to figure out what to do. I think he's just posturing. He's very good at spinning the ether into what he wants versus what's actually happening.
It's not me. I'm trying to be the savior.
Yeah. I think he knows what he's doing. I think
I agree. I don't think they're going to go bankrupt. I just think that if I was Bank of America, I would be very irritated with him
Yeah.
after
Well,
giving him billions of dollars.
I mean, like, what, the banks have never been given millions of dollars they didn't pay back? Come on.
Next week, we have a lot of information. We have some of the retailers reporting earnings, Home Depot and Walmart on Tuesday, Target, Lowe's, and TJX on Wednesday. And then GM has its big investor day on Thursday, but it might be a macro week again. We have retail sales on Wednesday, industrial production on Wednesday. We have a lot of CPI reports out of Europe. And then we have Jim Bullard, Mr. Bullard, on Thursday. He's going to be discussing monetary policy. Tom, what are you looking for?
I mean, the big ones for me is I'm interested to see how the CPI numbers come out for the UK and the Eurozone, as well as the PPI for the US, which is going to show, producers price index. So if we see a deviation where we're seeing increased inflation elsewhere, or we see the PPI in the US come in much hotter than the actual CPI number, I think we could see a serious pullback, from where we are today. I just think that, any little crack in this narrative is going to cause some problems. And so that's what I'm looking at. And then, of course, Jim Bullard, always a bummer, always. I would argue he was ahead of the curve in terms of raising rates. And there's a lot of talk yesterday about maybe we've reached the terminal rate. Maybe it's 4.5, which means 2 more rate hikes and then we're done forever. I just don't think that's the case, but I do think Jim Bullard could be someone who comes out and says nothing has changed, except for the fact that we actually got 1 month worth of CPI change. And that doesn't mean anything. We're still at 7.7, which is exceptionally high.
He's going to do something. It could be either way, but he could either say that we need rates to be 8%, interest rates to be 8%, or he could say, we'll hike in December and then we'll be done.
Yeah.
I mean, he could say either of those, both extraordinarily likely possibilities. That's Thursday morning at 8 a.m. So we'll probably be able to talk about that on this podcast. That's it for now. Have a great weekend. Stay dry. Thank a vet, and we'll see you on Monday.